Hello and welcome. In this presentation, we will be deconstructing one of the most fundamental financial statements, the balance sheet. We'll look at it not just as an accounting document, but as a strategic snapshot of a firm that helps us understand what a company owns and what it owes. Our agenda today will take us through the balance sheet in a logical sequence. We'll start with the big picture, what the balance sheet is, and its fundamental equation. We'll then analyze the left side of the balance sheet, the firm's assets, and discuss the important concept of liquidity. Next, we'll move to the right side to understand the firm's liabilities and shareholders' equity. We will also cover a key metric derived from the balance sheet, net working capital. And finally, we will discuss the crucial distinction between market value and book value to understand what the balance sheet doesn't tell us. So, what is the balance sheet? It's a snapshot of a firm's financial position at a single point in time. It's a convenient way of summarizing what a firm owns, which are its assets, and what a firm owes, which are its liabilities. The entire structure of the balance sheet, as you can see in this diagram, is governed by one fundamental identity. Assets equals liabilities plus shareholders' equity. This equation always holds true because shareholders' equity is defined as the residual value that remains after all of the firm's liabilities are paid off. Let's take a closer look at the left side of the balance sheet, the assets. Assets are classified and listed based on two key characteristics, their life and their liquidity. In terms of classification, we have current assets, which have a life of less than 1 year and are expected to convert to cash within 12 months. Examples include cash, inventory, and accounts receivable. We also have fixed assets, which have a long life and are not expected to be converted to cash in the normal course of business. Fixed assets can be tangible, like a truck or a building, or intangible, like a trademark or a patent. In terms of organization, assets are listed on the balance sheet in order of decreasing liquidity. Liquidity simply refers to the speed and ease with which an asset can be converted to cash without a significant loss of its value. The right side of the balance sheet tells us how the company has financed the assets that it owns. There are two main sources of financing, liabilities and shareholders' equity. Liabilities represent what the firm owes. They are classified as either current liabilities, which are debts that must be paid within 1 year, like accounts payable, or long-term liabilities, which are debts not due in the coming year, such as a 5-year loan. Shareholders' equity represents the residual value. It's the portion of the company's assets that belongs to the owners or shareholders after all of the creditors have been paid. The use of debt in a firm's capital structure is known as financial leverage. It's important to remember that while debt can magnify gains, it also increases the risk of financial distress. From the balance sheet, we can derive a key metric for analyzing a company's short-term financial health, net working capital. Net working capital is simply the difference between a firm's current assets and its current liabilities. It represents the cash that is expected to become available over the next 12 months in excess of the cash that must be paid out over that same period. For this reason, a positive net working capital is usually considered a sign of a healthy firm. For example, if a company has current assets of $100 and current liabilities of $70, its net working capital would be $30. This next concept is one of the most critical for understanding what a balance sheet truly represents. The values that are shown on the balance sheet are not necessarily what the company's assets are actually worth in the real world. The balance sheet reports the book value of assets. Under generally accepted accounting principles or GAAP, assets are carried on the books at their historical cost minus any accumulated depreciation. This is the value you see on the statement. In contrast, the market value is the price that those assets could actually be sold for today. For fixed assets, These two values can be wildly different. Furthermore, some of the most valuable assets that a firm possesses, like a strong brand name such as Coca-Cola, a good reputation, or its talented employees, don't appear on the balance sheet at all. To see just how dramatic the difference between book value and market value can be, let's look at a real company, Microsoft. We'll use their data from the fiscal year ending on the 30th of June, 2023. If we look at their balance sheet, the book value of their total shareholders' equity was approximately $206.2 billion. This value is based on the historical cost of their assets. Now, let's look at their market value. On that same day, the market capitalization of Microsoft, which is the value the stock market assigned to the company's equity, was approximately $2.5 trillion. So why is there a roughly $2.3 trillion difference? It's because the market value reflects many valuable assets that are not fully captured on the balance sheet under GAAP. So let's summarize what we've learned. The balance sheet is a snapshot of a firm's financial health, and it's governed by the fundamental equation: assets equals liabilities plus equity. We've seen that assets are organized by liquidity and that net working capital is a key measure of a firm's ability to meet its short-term obligations. But crucially, we must remember that the balance sheet is recorded in book value, which is based on historical cost, not the true economic market value of the firm. For strategic decision-making and for valuation, managers and investors must look beyond the book value to understand the true market value of the firm.